For decades, investing in the stock market felt like a high-stakes arena reserved for the wealthy and well-connected. You had to navigate the chaos of the New York Stock Exchange floor, which acted as a velvet rope for the average person's finances. But if we look at the reality of the market today, that entry price has collapsed. You can now start building a portfolio with as little as $1. This shift was driven by the rise of zero-commission brokerages and the normalization of fractional shares, which allow you to buy tiny slices of a single stock instead of waiting until you can afford a full share. The gatekeepers that once stood in your way have been cut out. In 2026, the traditional trading floor has been replaced entirely by a smartphone app. There is a catch to this newfound accessibility. Before investing a single dollar, you need a rigid financial foundation to avoid total disaster. This chart shows the mathematical trap of consumer debt. If you're paying 20% interest on a credit card, that debt is growing twice as fast as the 8 to 10% returns the average stock market investor earns. You also need an emergency fund covering 3 to 6 months of expenses. This acts as a psychological buffer, ensuring you don't panic sell your stocks to pay bills during a sudden market downturn. Attempting to invest without clearing high-interest debt and building cash reserves isn't wealth generation. It's building a financial house of cards on a fault line. Once that foundation is set, fractional shares allow you to deploy small amounts of money immediately. Instead of waiting to save $300 for a single share of a tech giant, you can simply buy a $5 slice of it. Micro-investing apps automate this through roundups. Every time you buy a coffee, the app takes your spare change and diverts it into the market. These automatic actions remove the psychological friction of parting with a large lump sum of cash. You are participating in the market without even feeling the cost. The total amount of that first deposit no longer dictates your success. What matters is establishing a frictionless habit of participation. To combat the anxiety of a fluctuating market, investors use a specific strategy called dollar cost averaging, or DCA. This jagged line shows typical stock volatility. With DCA, you invest a fixed dollar amount at regular intervals, regardless of price. Because your amount is fixed, you automatically buy more shares in a valley and fewer at a peak. Over a long-term horizon, this continuous cycle smooths out your average purchase price. DCA removes the impossible task of timing the market. It transforms volatility from a source of stress into a mathematical advantage. So where should those automated dollars land? You want maximum diversification. You'll typically choose between index funds and exchange-traded funds, or ETFs. Both hold a wide basket of stocks, but ETFs trade continuously throughout the day like a single share, while index funds are priced only once at the market close. These vehicles allow a $1 investor to instantly own a microscopic, diversified slice of the entire global economy. This accessibility also extends to real estate. You no longer need a massive down payment or the active duties of a landlord. REITs, or real estate investment trusts, allow you to buy liquid ownership in commercial properties, like warehouses or apartment buildings. You can now collect property dividends without fixing a leaky toilet or signing a 30-year mortgage. When you remove the requirement for a massive initial deposit, you are able to prioritize the most important variable in your net worth: time. This comparison shows why. The left chart tracks an investor starting early, curving exponentially upward. The right chart begins 10 years later with larger contributions, but struggles to gain momentum. An investor starting at 25 vastly outperforms someone waiting until 35 due to compounding. The data is clear. Time in the market will always defeat attempting to time the market. Fractional shares and micro apps have converted building wealth from an active stressor into a background habit. These tools have shifted investing from a high-stakes gamble into a patient process of accumulation, the exact strategy championed by Warren Buffett. The size of your deposit no longer limits your financial future. The best time to start building wealth was yesterday, but the second best time and the most accessible time in history is today.